Mixed vibes are in the air right now, with markets expecting a greater chance of a Fed cut next week, while there is lots of caution in the air, and that's broiling from Bitcoin's demise. My name is Jessica Amir, a market strategist here with Moomoo. It's great to have your company on this second day of December. So what is happening in markets right now? Well, on one hand, we've got the key indices moving lower. The Nasdaq 100 down 0.4%, the broader S&P 500 falling about 0.5%, falling below a key level at one point of 6,800 points. And that basically suggests that investors are avoiding some risk ahead of the Fed's inflation gauge being released this week. Of course, that's the big make or break moment before the Fed make their decision next week. What's also telling is that the most selling in stocks overnight was in stocks like Shopify falling about 6% and Broadcom falling about 2%. But these stocks have been packing their punch of late. But what is pressuring markets broadly is that there is serious worry that investors may be needing to sell some high-flying S&P 500 and NASDAQ positions to cover Bitcoin's margin loans. And that's because Bitcoin is continuing to crater. We've seen Bitcoin continue to fall, and $1 billion in leveraged crypto positions were wiped out overnight, with Bitcoin now being down 31% from its record all-time high. So who is selling? Well, it's those that were chasing Bitcoin, and they took out leverage loans ahead of Bitcoin surging to 125,000 US dollars 8 weeks ago. But then we saw Bitcoin slide to $90,000 and then hit fresh lows overnight, $85,000. So we're seeing millions of investors essentially being forced to sell. The concern is if Bitcoin keeps falling, forced sales could continue, and these investors will need to cover the margin loans that they took out. And this is why I'm saying that the equity market darlings of 2025 could be pressured if we see Bitcoin continue to fall. So that's a consideration. But I always say there's a bull market somewhere. And I guess that also brings about opportunity. So speaking of opportunity, I guess we have to reinforce the case for the US central bank to cut interest rates next week has gained momentum overnight for a couple reasons. We saw 3 data sets come out from the US overnight, basically saying, hey, the US economy does need a little lifeline. So we saw weakening ISM employment and also weakening manufacturing data, with manufacturing falling for the 9th straight month. So this is where it gets really interesting and juicy. Quality stocks tracked by the Qual ETF hit their second highest level in history overnight. And this is really suggesting that investors are believing as the economy slows and the Fed will come to the rescue and step in and cut interest rates, quality stocks will rise to the top. So you should be keeping your eye on quality stocks and ETFs in 2026. That's today's focus. So we all know US interest rates, they when they're cut, they support equities overall. But given the narrative, as we're suggesting, or as I'm suggesting, is that economic growth is slowing, the world will typically favor quality companies. And this is exactly what has occurred throughout history. When we see markets fall and markets go into distress, we usually see those quality stocks kind of be market stalwarts and rise to the top or outperform the broader market, which is declining. So the thing is that you might be asking, what is a quality stock? Well, simply they are large international companies with strong profits, consistent and stable earnings, and we also call it low debt to earnings. This basically means lower debt levels compared to the earnings that a company makes. Now, throughout history, again, just reinforcing this point, quality ETFs, such as those tracked by the QUAL, have outperformed the broader market when the broader market has been declining. So the Qual ETF doesn't decline as much, but of course, it is not immune to pullbacks, but it typically bounces back the quickest. So why is this? Well, we have to think about the constitution of a quality company. And what is included in the quality ETFs? Well, the world's top 5 quality companies, as deemed by MSCI, are Apple, Microsoft, Nvidia, Meta, and Eli Lilly. And each and every quarter, these companies are bought the most simply because they form a part of the quality ETF. And they're bought by investment managers. They're simply buying into the ETF and buying these stocks every quarter. So that's a consideration. That means that these companies have a history of recovering from pullbacks as well because of the nature of them being bought so much. And that's exactly why we are seeing markets take a step lower despite the risk off, and these stocks in the ETF are trading at some of their highest levels in history. So the other thing is these companies, as we're saying, they're not only viewed as market stalwarts, but also consider that these companies also tend to make money no matter what happens in the economy. And this is the thinking as well on Wall Street. And this is indeed perhaps something that you should consider if you are building out your portfolio for 2026. Let's just move to stocks to add to your watch list now. Perhaps one of those is CrowdStrike. And CrowdStrike is not in the quality ETF, but it is deemed the most quality cybersecurity company in the world simply because of its large scale and recurring revenue. So why are we talking about CrowdStrike? Well, they're due to report quarterly earnings tomorrow morning US time. So the stock has been doing really well. It's up 45% year to date, and the cybersecurity giant. Why is it deemed high quality? Well, 95% of their revenue is under subscription. So we're again going back to the point about recurring revenue, and that's what makes a company quality. The business is also seeing renewal orders growing faster than ever before. This basically also indicates that their moat is pretty sticky, and they're gaining market share in a leading position that they're already in. Remember, other companies that rival this include Palo Alto, so keep an eye on that company as well. But back to CrowdStrike, they recently struck a partnership with Amazon's AWS to deliver streamlined services to AWS customers. As for what to expect for CrowdStrike themselves, well, their revenue is expected to continue to grow year on year. It's growing at about 20%, and the expectation is that that will continue to grow 21% year on year over the coming year and the year after that. CrowdStrike is rated as a strong buy by analysts. Changing pace to a company called Synopsys. This is a semiconductor software design company, and their shares did really well. They were a standout performer overnight. They jumped about 5%, and that's because Nvidia invested $2 billion in the company, taking a stake in the engineering group really to build out AI computing technology across more industries. We also heard from Nvidia's CEO, Jensen Huang, saying the partnership is a technology upgrade, saying this will speed up the adoption of artificial intelligence and accelerated computing in automated design in this new industry that the company is I guess, making headway into. The partnership also involves integrating Nvidia's tools into Synopsys's chip designs and applications. And the companies together are looking to deploy AI agents and together work on joint marketing. So this is a company that you should keep on your radar, particularly because the company did really poorly after reporting results. They have declined about 36% in September. The market didn't really like what they reported, and they haven't yet recovered. They're still down 11% year to date. Nevertheless, the stock has got a buy rating among analysts, and you might be betting your bottom dollar that this company will probably see plenty of upgrades given the endorsement from Nvidia. So keep this stock on your radar. I'd be expecting upgrades and potentially it to embark on an upgrade cycle. Speaking of upgrade cycles down under, we've got a company that is moving and shaking. Yesterday it was in the leaderboard, and that's Greatland Resources. It's a gold and copper play. Yesterday, it was the best performer in the ASX 200, up 10%. So what happened? Well, great question. I'll answer it. They basically released a preliminary study or a feasibility study confirming that their Aussie mine here in Australia has got a very clear pathway to become a world-class, long-life, lowest quartile Australian copper gold miner for 17 years. The feasibility study also suggests that they've got a steady rate operation ability to make pre-cash flow of about $739 million per annum or $1.2 billion per annum, and that's based on the gold price as at yesterday. Macquarie reiterated the stock as a buy, and that's the consensus among analysts. Macquarie's price target is at $10.50, and that implies 26% upside from where it closed yesterday at $8.32. Also, bear in mind that Greatland has been benefiting, of course, from the rise of the gold price. And this could be further boosted if we see the US central bank cut interest rates next week. The stock is already doing really well, up 17%, but you may expect this stock to pack further punch from next week.